Hi, my name's Andrew. Thank you for visiting my YouTube channel. This is another video on a series on real estate fundraising, and this video covers navigating from a term sheet to a MOU. This is part of my series of videos on fundraising due diligence and process. It's mainly to be used as a tutorial to help people with the procedures when it comes to raising funds for any real estate project, typically ones in the $10 million to $100 million range. So let's start to talk about how to move from a term sheet to a MOU. So a lot of the details in this video come out of my real estate capital fundraising guide and my due diligence guide. These are two guides that I created for real estate firms to help them with the fundraising process. They're both around 75 pages each, so most of the information from this video comes from the Ultimate Guide to Raising Real Estate Capital. So before we get to the video, this is just a really quick look at the Ultimate Guide to Raising Real Estate Capital. This is a comprehensive guide with absolutely everything in it that you need if you're a first-time fundraising anywhere from $10 million to $100 million. This is ideal for real estate companies who really want a bit of a guideline of how to manage the process. Absolutely everything in here, from corporate to legal to due diligence, and it's all part of a package that I created specifically for real estate companies in 2025. So starting off, why the process matters. Many deals fail due to poor groundwork before the MOU stage. So the key question that you need to ask yourself is, are you confident you've covered all the steps to reach a binding agreement? Key word there is binding. A term sheet is going to be non-binding until it ends up going to the MOU stage. So let's look at the overview of the process, but I want to also point out in the very beginning that you will need to get legal and financial experts involved in this process. It really depends on how early you want to get them involved. If you're confident and you have experience in putting these type of agreements together, I would wait till the last moments. Lawyers are just going to eat up a lot of your money and your time getting information back to you. So if you have experience, term sheets are not that difficult. Turning it into an MOU is the more technical part, but the term sheet is basically just yourself and the other party bouncing the ideas back and forth, and again, non-binding. Then it gets put into the MOU and you're going to clean it up from there. So that's my point on the legal end. Again, I would only include the legal lawyers at the later stages of the documents. So the goal is to create alignment, clarify expectations, and mitigate risks before signing the MOU. Remember, a term sheet's a partnership at the end of the day. There are three stages. One is the pre-term preparation, 2, drafting and negotiating the term sheet, and 3, refining the details to transition to the MOU. So again, this is the back and forth process between both parties. So stage 1, the pre-term sheet preparation. For example, the fundraiser or the project sponsor, they will define the objectives. That could include equity, debt, or a hybrid. Prepare the detailed metrics, the IRR, ROI, timelines and exit strategy. Conduct feasibility studies to identify potential red flags, and clarify negotiable and non-negotiable items. And the investor or the funding party is going to define investment criteria, sector, geography, risk profile, review sponsor materials to validate credibility, and then engage legal and financial advisors early. So the investor would want to engage lawyers earlier, probably, as opposed to the fundraiser. Again, it really depends on the expertise. Challenges: misaligned expectations on control or profit sharing. That comes up quite often in the very early stages. And 2, lack of clarity on project risks or timelines. With every project, we're talking mainly real estate here, especially if it's a development or acquiring pre-built assets, income producing assets, whether they're residential or commercial. There's always going to be some risks or timelines in the process. So stage 2, drafting and negotiating the term sheet. The fundraiser is going to draft a flexible, clear term sheet. You're going to see examples of this coming up a little bit later, how I show how a term sheet gets converted into a MOU, at least in basic format. So you have to be transparent about the financial assumptions and anticipate investor concerns about risks or returns. On the investor side, you're going to check the alignment with the goals, review for vague clauses, negotiate terms, control funding milestones, and exit preferences. So basically, control and funding milestones are really key on the investor side. Request supporting documents for validation. This is all part of the DD as well, which we touched on a little bit earlier. Common pitfalls, missing critical clauses like dispute resolution and unclear timelines for due diligence. Stage 3, refining the details for the MOU. So now you've gone past the point where the term sheets all agreed on, and now you're going to start to build your MOU. So the fundraiser's going to address all term sheet points, funding tranches, profit sharing. They're going to prepare due diligence packages, financials, legal property details, and draft a clear, detailed MOU with legal advisors. Now, on the investor side, you're going to conduct the due diligence on representations. You're going to review the MOU for enforceability and risk mitigation. Those should be simple items that the legal team can take a look at. If it's something that involves cross-border issues, then there's going to have to be some attention given to that as well. And you're going to request amendments for gaps in the term sheet. Key milestone, final agreement on terms, ready to sign the MOU. So practical tips for a smoother process. Communication is key. I found this in many of the deals that I've been involved with over the years is one party doesn't communicate as well as the other. Generally, the fundraiser is going to be the one that wants to follow up more often than the investor, because after all, they want their money and their funds as soon as they can. So there's always one party that's pushing for some sort of results. You can use a checklist to ensure no critical elements are missed. Generally, if there's a delay on the investor side, that means there's some issue regarding the DD material. It could be the financials, it could be other contracts. Communication is the only way that you can keep the process moving. No relationship can survive in a vacuum. I have the same problem with clients. I've got contracts out to get signed, and they've said they've sent them off to the lawyers, and you don't hear from them for 3 or 4 weeks. So again, it's the vacuum of information which makes it hard to navigate, especially if you're on the fundraising side, because you're thinking, okay, if this party isn't getting back to me, should I be reaching out to other people on the market? So those are key things that you have to navigate. Plan contingencies, address funding delays or market shifts proactively. Any delay is going to cause more risk as far as market shifts. If it's a short one or 2, 3 months, it's not going to be affected too long. But if there's a delay of 6 months or 12 months in the process, well, real estate markets can change in that shorter time, depending on geopolitical, geographical, economical reasons. So that's why it's important to move fast when you're getting into the MOU stage. So let's see what this looks like as far as on a paper comparing the two, a term sheet and the MOU. So here I've got a simple document that I've created that just has the key terms or headings in a term sheet, a little bit of an expansion on what would be the title on the MOU, and then just a detailed description of the MOU content. Now, most MOUs are going to be 30, 40 pages in some cases, and a lot of that is just legal jargon. The most important thing is to make sure that the points here are agreed on and clarified. And as you can see, there's not a lot here that needs a lawyer to be at this stage. You could almost get to the point where you're drafting up the MOU and then giving it to a lawyer, especially if you're senior people on the fundraising team, or let's say the real estate side. and the investor side. The two parties can hammer out the deals pretty well because for the most part we are almost always talking about people who are experienced at putting these things together. There are some terminologies and some clauses that can make it a little bit challenging, and that's when you may want to get your lawyer involved or a third party that knows about structuring deals. So that's why I can generally get most term sheets to an MOU with just the experience that I have, even though I'm not a lawyer, obviously. So let's just talk about the introduction here. So key terms, term sheet part, MOU part, and then a detailed description of the content. So introduction is going to be the purpose and scope of MOU, and that includes the rationale for the MOU, its legal standing and scope, such as formalizing mutual intentions and setting the stage for a definitive agreement. It may also highlight overreaching project objectives and strategic alignment. Parties involved, pretty straightforward. You're going to have the parties that are included. So this provides complete legal identities of all parties, including corporate registrations, registered addresses, and the roles they will play in the agreement. Also specifies any subsidiaries and affiliates involved, and you're also going to have supporting DD items on top of that. Project overview, a brief description of the project on the term sheet. Then on the MOU it's a little more comprehensive because it elaborates on the project's purpose, technical details, location, estimated costs, anticipated outcomes, includes specifics like market opportunities, feasibility results, and alignment with industry best practices. So again, just clarifying a little more about what the project's about. Now the investment structure is really important. This is the proposed deal structure, one that is usually the key bargaining and negotiating point in everything. So it's the agreed deal structure. So when you're talking term sheet, it's proposed. Then when you're talking MOU, it's agreed. So you've agreed on it, and that's how it goes. When it goes on the MOU, you should not be doing any more negotiating, because that's generally when things fall apart. One party says, oh, I want to change this, and the party goes, wait a second, you can't really do that, or you shouldn't do that. So on the detailed description on the MOU, it fully specifies the equity or debt structure, outlining percentage ownership, voting rates, and the capital commitments, include specifics on hybrid models if applicable, and provisions for future funding rounds and evaluations. Next, funding terms. This is the high level funding amount and timeline on the term sheet. On the MOU, you're breaking it down to specific funding terms and breakdowns. So you can see on each of these, it's just an advanced part of the structure. Details the funding amount, schedule of tranches, conditions for fund disbursement, and any escrow requirements. Includes provisions for additional funding or revisions to terms based on milestones achieved. Profit sharing and returns. So this is the proposed profit distribution model on the term sheet, and then it's more defined profit sharing mechanism of how that will go when you get to the MOU. So this specifies the distribution schedule hierarchy, for example, preferred returns, waterfalls, and the percentage allocation between parties. It also addresses contingencies for underperformance or delayed profits and any clawback provisions. I've handled a lot of real estate development sales agreements, both on my side as the salesperson and my side working for the developer, and we always got into a lot of issues when it came to clawback on commissions. I, for one, like to say that it's really hard to get that back, and it's really hard to hire really good salespeople if you're saying, well, if there's a problem, we're going to claw back your commissions. So generally, I like to sit in the middle as when it comes to that particular issue. But when it comes to more sophisticated real estate acquisitions or development processes, then clawbacks do come into play. But they have to be really defined, because if I'm going to be going to court with somebody, it's almost always going to be about fees and clawbacks. Milestones and deliverables. So this is key preliminary milestones from the term sheet side, and then the detailed timelines and penalties, if any. So it includes a timeline of critical deliverables, permits, construction milestones, or revenue benchmarks, with detailed metrics for evaluation. It defines party responsibilities for meeting milestones and consequences of delays and failures. So moving on to the second sheet, we're at the due diligence point. So the term sheet would have the outline of due diligence requirements, and then on the MOU side you're looking at completion and results of due diligence. So that includes summarizes findings from legal, financial, and technical due diligence processes, includes documentation of property appraisals, market analysis, environmental assessments, and any identified risks or recommendations for mitigation. I've seen this happen on the real estate development and acquisition side, where one party wants to acquire a number of assets and they're bringing in a partner for it. Might be 2 or 3 buildings. The financials have been run by the real estate fundraising party, but the investor comes in with their team and says, hey, you've missed out on this, or your assumptions here are wrong. And then that's where the due diligence really comes in. Again, I've got 75-page guide on real estate due diligence that I prepared for a party, so there's a lot of information that's involved in that. Due diligence is a long process. Conditions precedent as a heading, so that those are the broad conditions to be met before closing. And of course on the MOU you're going to be looking at the detailed preconditions. This enumerates all conditions that must be met before signing the definitive agreement, such as regulatory approvals, third-party consents, satisfactory due diligence, and includes the deadlines and fallback options if conditions are not met. So think of it as just a long checklist that you have to have all the check marks done before the deal closes. And none can be missed. Roles and responsibilities, so this includes on the term sheet side the preliminary assignment of roles can be changed during the process if it's determined that one party might be better suited to handle it, or it's part of a negotiating clause. So on the MOU you're going to have the fully defined roles and responsibilities, and then the language under that is clearly delineates operational responsibility, management duties, and decision making authority for each party. Includes mechanisms for dispute resolution within roles or for reallocating duties in unforeseen circumstances. Moving along to governance and control, this is high-level governance structure in the term sheet. Then when you're looking at the MOU, you're looking at detailed governance and decision making. So this is a part of the MOU that requires a lot of focus, because it specifies voting structures, veto rights, board composition, meeting schedules, may include management protocols for day-to-day operations and reserved matters requiring unanimous consent. Then we're on to exit strategy, initial discussion of exit scenarios. At the end of the day, if I'm an investor, I want to know, okay, I'm investing in this, how am I going to get out of it? Because at the end of the day, it could be, am I getting out of it by exiting or buyout, public listing, asset liquidation, includes valuation methodology, timelines and conditions for invoking exit clauses. Also addresses restrictions like lock-in periods or first right of refusal. So those are going to be more defined in the MOU. Confidentiality, that's just a boilerplate, high-level confidentiality, detailed confidentiality. I think most of these are pretty simple. But this spells out obligations to protect sensitive information, including specific exclusions, duration of confidentiality, and penalties for breaches. May also include provisions handling data post-agreement or during disputes. When I'm setting up a data room for a client, especially if it's on the fundraising side, I say let's work on different levels where first parties get access to this type of information. It might be marketing, initial plans, and then each step of the way needs something from the investor. Could be an LOI, could be the MOU itself before you can take a look at the final financials. I've seen it happen before. Or if there's some special confidential issues, maybe the fundraising team is in the middle of a negotiation already with a big party to that could really enhance the deal, but they can't put it in the deal yet. That might be something that says, listen, you can we can show you some potential deals we're working on, and identifying them. Saying that you're working on potential deals, building A, building B, building C, 10 million here, 20 million here, 30 million here is fine. But if you're saying, hey, I'm looking to buy a portfolio off of this particular person or this developer, maybe the investor's saying, wow, that really is going to enhance this deal significantly because you're buying prime property from from an identified party. So that's why the confidentiality is really a key point in any deal. Then you're looking at legal and regulatory compliance. So again, these are more boilerplate, defined legal framework. This lists the specific regulatory requirements such as licenses, permits, adherence to local laws, includes responsibilities for ongoing compliance, reporting obligation, and penalties for non-compliance. Dispute resolution. This is a boilerplate again on pretty much every contract you're going to see, from real estate to venture capital to even employment contracts. So that includes just the high-level resolution, detailed resolution. This specifies the process for resolving disputes, includes steps for negotiation, mediation, or arbitration. Nobody wants to go to court a second time, especially two partners, so identifies the governing law, jurisdiction, arbitration volume, and timelines for resolution. Hopefully, most people don't want to ever get to that point. So moving to the last three, the timelines, really important. This is the indicative timelines. Then when you're on the MOU, you're on firm timelines. And it provides a detailed project schedule with deadlines for each phase, milestone, completion dates, and review periods. Includes provisions for handling delays and force majeure events. I've been involved in a number of real estate projects, especially on the condo development side, where you're doing pre-sales and you've got to have in each contract a bunch of timelines, which are usually backed by government entities. At least they are in places like Canada and the USA. Funds are usually put in escrow, so you can only get the funds at these certain times. And then there's always what we call the drop dead periods, where after a certain date has been reached, money's got to be returned, and there's usually a number of steps involved in that to keep pushing that further and further. But the drop dead date usually is pretty firm and cannot be changed. Non-binding and binding nature. So this again are specific. Then you have more specific clauses that include confidentiality, dispute resolution, and which are non-binding. Intent to negotiate clarifies legal consequences of breaching binding terms. For example, if we have a exclusivity, let's say we're the fundraising real estate group, we're looking to raise capital or find a partner. We start to engage with an ABC company. ABC company, as part of their letter of intent, says, listen, we've got exclusivity to negotiate with you for 60 days or 90 days. If one of the parties, usually the fundraiser, all of a sudden starts to negotiate with another party, then there's a clear issue there where some terms have been breached. It's really going to kill the deal, kill relationships. Nobody wants to get into those, but there's something that should be built into the agreement. Because on the funding side, or on the side, let's say I'm with a real estate and we're looking to do the fundraising, I want to say to this group, we've got some interest, we've got interested parties, but we're willing to give you 60 days to negotiate where we won't talk to anyone else. That's a key point. And the whole idea is that we, as a real estate group, don't want to break that, but what we want to say to the other party is, if you're interested, if you're serious, we'll give you this amount of time. And it also helps set a timeline. You can still engage with other parties as far as communication, but you have to disclose, hey, we're in a 60-day period with this group. We're happy to come back to you on day 61 or sooner if the other party has a clause which allows them an out. So it's really key that that's in the MOU. Lastly, signatures, very boilerplate, just includes everybody that's involved in the contract. So that is the more detailed description of how you would take a term sheet and turn it into an MOU for your project. So in most cases, for these type of scenarios, I've just taken a look at the part when the investor responses have been coming in, but as in my previous couple of videos, from the start to the finish, it could take anywhere from 9 to 12 months. I usually tell clients from the moment we have the initial kickoff meeting, once you've appointed us to help you with the fundraising, factor in 9 to 12 months before you end up getting your final investment, depending on the project complexity, investor responsiveness, and external factors. I hope you enjoyed that video. Just a quick bit about myself. I'm a fundraising strategist with 15 years of experience in high-end real estate sales and marketing spanning Canada, Dubai, and the Caribbean. And over the last 3 years on Fiverr, I've assisted over 300 clients with startup fundraising, pitch deck refinement, investor outreach strategies, and custom investor databases. In addition, I serve as an advisor to a New York-based private equity firm with a capital commitment of $10 billion. This capital is strategically allocated to projects across the Middle East, Asia, and the USA with a focus on income-generating real estate. The firm offers both debt and equity financing with investment sizes ranging from $10 million to $100 million per project. You can get more information about my background and services by clicking my Fiverr link below. Thank you for watching this video. Please like, share, and subscribe.